Hi, we are the Group E2 Accounts on Me. I'm Lee Ho Cheng, and I will explain question 1, the difference in before-tax income between the CEO's and header's accounting method. The method suggested by Harvey Dent, the CEO, neglects the impairment of the equipment of the frozen food line. As a result, the calculation will be as the following. There will be no write-off of value for the value of the equipment. So the depreciation is calculated based on the current book value of $33,600,000. For the remaining life of 3 years, the depreciation expense per year will be $11,200,000. However, for the correct approach, the impaired value should be written off in the current year, so that in terms of current net book value of $33,600,000, the depreciation will be based on the next carrying value of $20,700,000, which is the value after deducting the impairment loss of $12,900,000. The depreciation expense as a result will be $6,900,000. With the approach of Dent, depreciation expense will be $4,300,000 higher than header's approach. However, if impairment loss is also taken into account, net income before tax in header's approach will be $8,600,000 lower, which means there will be an overstate of net income.
I'm Chan Ching-Han Ellis, and I will now talk about the pros and cons of following CEO's advice. Regarding CEO's approach, it is expected that earnings can be smoothed by omitting the expense of impairment loss. This can surely boost the profitability of Health Life Food Company by creating a false image that it has an outstanding financial performance. Moreover, as investors are more confident in the company's value, the demand for its stock will increase and thus push its stock price. Reputation and goodwill of the company will be polished too. On the other hand, the failure to expense the impairment loss cannot allow the company to genuinely reflect its financial health, as its equipment is exaggerated. In the worst-case scenario, lawsuit and litigation will be faced by Healthy Life Food Company due to the fraud on income manipulation and taxation. Eventually, all this will tarnish the company's credibility and put the company into crisis.
My name is Xiu Wang. The request suggested by the CEO violates the consistency and matching principle of the IFRS. The ethical dilemma that facing Heather is the obligation to challenge the questionable application of revision in service life, more important than her obligation to her boss and to the company's effort to reflect a favorable net income. The consistency principle of IFRS 8 states that business has to stick with the adopted accounting principles or procedures consistently throughout the future accounting periods. It provides the guidance for recording the loss of impairment on partial writing down of equipment. All of the changes on the accounting methods require to have a valid reason, and the effects of the change have to be disclosed in the financial statement clearly. The company must abide with the accounting principles, as they are the standard norm of rules, which companies can maintain consistency in recording financial transactions. In this case, reflecting a favorable net income cannot be considered as a valid reason to change the accounting method.
Hi, I'm Chin-Si Chloe. Besides, the action of CEO violates the matching principle referring to the IFRS 8. The matching principle states that revenue should be recorded during the period in which they are earned instead of when the cash is transferred. On the other hand, the impairment loss suggested by Heather is recognized when the book value is not recoverable. Thus, the impairment loss of $12,900,000 of equipment cannot be replaced by changing its remaining life, as the remaining useful life has to match with the economic benefit generated by equipment. The service life of assets should remain at 10 years instead of 5 years. As seen from the above, Healthy Life should recognize the impairment loss of $12,900,000 instead of shortening the remaining useful life in hope to create favorable profits.
In the following session, we will look into two related cases to see the consequences of failed treatment on impairment loss. I'm Manchurian States. The first company that we are looking at is called the Iconics Brand Group. So it is an American brand management company that licenses brands to retailers and manufacturers primarily in the apparel, footwear, and apparel accessory industries. During 2013 and 2014, the US SEC accused Iconics for its intentional fraud. It has investigated that Iconics has improperly reported transactions related to its impairment testing for the amount of certain intellectual property assets related to 3 brands, despite clear indicators of impairment. Iconics instead used royalty revenue projections to calculate purported fair values for the 3 brands. This showed no relation to historical and expected future performance and were therefore unreasonable. It has found out that Iconics reported transactions fraudulently for supporting the distressed brand's unsatisfactory financial condition. This is similar to the situation that Healthy Life Food Company is facing, where its new frozen food line has declining sales. Thus, it is believed that the two cases are comparable. Let's take a look at the financial impacts brought by the flawed treatments. From Iconics' 2013 balance sheet, we can see that the reported amount for its Brand 1 and Brand 2 has been overstated by around 3 times than its true fair market value, while the reported amount of Brand 3 has been even overstated for 9.5 times than its true fair market value. And also, in 2014, even though the brands remained impaired and despite the continued presence of indicators of impairment, Iconics continued to fail to impair these intangible assets, resulting in continued material misstatements in its accounting for and reporting of these assets by hundreds of millions of dollars.
Thank you, Stacy. I'm Tiffany, and I'll now talk about the consequences faced by Iconics. Firstly, they face serious lawsuits as they violate the U.S. Exchange Act Section 13B2A, as evidenced by the failure to write down the value of its intangible assets as impaired, resulting to a penalty amount to US $5.5 million, while they neglect the impairment test for indefinite intangible assets, which is also the violation of GAAP. Moreover, the CEO, CFO, and COO were found to have consensus on estimation on revenue and EPS, so they are charged by the SEC for the misconduct. In parallel actions, the U.S. Attorney Office announced criminal charges towards all of them, ruining their reputation and profession. As a brand management company, the above accusations have rendered the credibility of all executive leaders of Iconics, which can seriously deteriorate their future prospects, where they have to put a lot of effort and time to reappoint their members and rebuild their reputation. So we strongly suggest that Healthy Life should indeed adopt a method which truly reflects the financial performance. Otherwise, they would have faced serious losses. We also suggest them to look into the reasons and solutions towards the declining sales so as to tackle the problem more accurately. Now, let's move on to case 2.
My name is Xiao K. Zhang, and I will continue with the case 2.
The batteries manufacturing company N1 sold batteries to Think Holdings and had equity investment and loan to Think. Financial loan and investment to Think further increased in 2010. However, Think's business performance deteriorated. The debt is therefore unpaid. Analysts impairment analysis conclude that Think's related assets were not impaired. However, the financial distress should be recorded for impairment of investment. The material misstatement caused an overstated revenue. Robert Hasseljesser, analyst CPA, accepted the inevident impairment analysis and was accused of improper professional conduct. The financial distress of Think is comparable to declining sale of frozen food lines. Also, management decision to not report impairment of assets. Hasseljesser's role is similar to that of Mayer in making the decision. Hasseljesser was accused of improper professional conduct. He was accused of relying highly on communication with management instead of reviewing properly. Reputation of Hasseljesser's qualification was destroyed. Moreover, Hasseljesser was suspended from appearing and practicing as an accountant. Observation from this case is that individuals will bear heavy legal consequences if one adopts improper behavior in hiding or not reporting impairment, which will be heaviest consequence.
Hi, I'm Chinqi Chloe. As seen from our two cases from Iconic Brand Group Incorporate and N01 Incorporate, both companies suffer from severe legal consequences and affect their business performance in the long run. Hence, healthy life should not shorten the remaining useful life of the equipment. As the CEO of a company, he is recommended to examine the IFRS standards or GAAP thoroughly before asking employees to make a mis-accounting treatments that violates the accounting standards, while Heather should abide by IFRS or GAAP standards rather than the CEO orders.